Welcome to the Deep Dive. Today we're jumping straight into some pretty big news shaking up the U.S. economy.
That's right. We're talking about the return of tariffs on Chinese goods. Feels a bit familiar, doesn't it?
It does. And what's really catching our eye is the immediate effect, the sort of ripple effect we're seeing in the U.S. bond market.
Yeah, it's quite something. We've managed to get our hands on some info detailing these new tariffs and, well, the pretty swift reaction from bond investors.
So our mission today, for everyone listening, is to try and unpack this, look past the headlines. What does it actually mean for your finances and just the wider economy?
Exactly. We want to cut through the noise, offer some clarity on what's really going on here.
Okay. So at the core of this, based on what we've seen, are two key things happening almost back to back. First, these new tariffs, both the U.S. and China imposing them.
Hmm.
And second, right after this surprisingly fast sell-off of U.S. government bonds.
A really significant reaction. So, yeah, where should we start? Maybe with the tariffs themselves.
Let's do that. What are the actual numbers we're looking at? Because I heard they were substantial.
Oh, they are. The details we have are pretty stark. The U.S. has slapped a, wait for it, 104% tariff on goods coming in from China.
Wow, 104%.
Yeah. And, well, maybe not surprisingly, China hit back pretty fast. They've imposed an 84% tariff on American goods going into China.
Okay, 84%. These aren't just tweaks, are they?
Yeah.
That scale, I mean, it sounds like it could just stop trade in its tracks for some goods.
It really could. Numbers like that can effectively shut down entire trade routes. It forces businesses to completely rethink, where they get things from, how they make things. It's a very, very aggressive move.
Definitely signals a sharp escalation. So for anyone listening who maybe doesn't follow trade policies super closely, just a reminder, tariffs are basically taxes on imports.
Right. Simple as that. A tax.
So when you see numbers like 104%, 84%,
Yeah.
the cost of bringing goods into the country just skyrockets. How does that hit businesses straight away?
Instantly. I mean, if you rely on imports from China, your costs just jumped massively overnight. Suddenly, your whole supply chain is way more expensive.
And the same for U.S. companies selling to China, right?
Exactly. Their products suddenly become much, much pricier for Chinese customers. It just throws a huge wrench into the works, into that whole global flow of goods and services we always hear about.
Those global supply chains.
Yeah, those really intricate networks, getting raw materials, making things, shipping them. These tariffs just disrupt all of that. It can mean delays, shortages, and ultimately probably higher prices for us, the consumers.
And the info we've got, it mentions the financial markets reacting immediately. Stock markets didn't like it, apparently.
No, not at all. The source material points to a negative reaction pretty much straight off the bat. Investors hate uncertainty and, well, a trade war kicking off like this. That's peak uncertainty. Big questions about company profits, economic growth.
Right. But what's maybe more unusual or concerning is that this nervousness isn't just staying in the stock market. It's spilled over into what's usually seen as the safe place to hide, right? The bond market.
Exactly. Which brings us to U.S. government bonds. So for anyone needing a quick refresher, think of these as IOUs from the U.S. government.
You lend the government money, they promise to pay you back with interest. Simple enough.
And normally when things get rocky economically, investors tend to, run towards these bonds. They're seen as safe.
Which is why what's happening now is so odd. The information we have says bond prices have actually dropped significantly.
Investors have been selling them off. And pretty quickly, too.
So why? Why now? The sources say bonds are usually safe havens. Is there something about these tariffs, this specific situation, that's changing that rule?
That is the million-dollar question, isn't it? And what's really telling isn't just the prices fell, but like you said, the speed and maybe the reason behind it.
Yeah.
Usually, economic trouble pushes people into bonds, but this time, the trouble is the trade policy itself, and it's pushing people out. That suggests maybe a bigger shift in how investors are thinking about the risk, the actual stability of U.S. debt, which historically has been, rock solid.
Okay, this is where it gets really important for listeners to connect the dots, I think, because there's this relationship, right, between bond prices and interest rates or yields.
The inverse relationship, yeah. When bond prices go down, the yield, the interest rate effectively goes up.
And the info we have is specific here. It says the 10-year Treasury yield, that's a key benchmark, jumped to 4.5%.
Which, as the sources note, is the highest it's been since back in February.
4.5%. And how fast did that happen?
That's the kicker. That 4.5%, it represents something like a 15% spike in yield in just a few days.
15% in days. Wow. That's
Yeah.
that's a really big move for the bond market, isn't it? That market usually moves much more slowly.
It's incredibly fast.
Mhm.
And it's not just, oh, new buyers get a slightly better interest rate. It has
Right.
much wider impacts, right?
Exactly. And there's a quote in our source material from Laith Khalaf at AJ Bell that really hits this home. He says, let me find it. Yeah, bonds should thrive in turmoil as investors flee to safety. But Trump's trade war is undermining the U.S. debt market.
Undermining the debt market, that's strong language. The traditional safe place is actually being weakened by the cause of the turmoil itself.
It really is. So this brings us to the so what for everyone listening.
Right?
Why should you care about bond yields going up? Well, it's not just abstract financial stuff.
Yeah.
It has real, tangible effects on borrowing costs for everyone.
Precisely. Higher government bond yields mean it costs the government more to borrow, and that tends to push up borrowing costs for, well, everyone else too. Companies, mainly. Think about it. If the benchmark risk-free rate, the government bond yield, goes up, then loans to companies, which are inherently riskier than lending to the government, also have to offer a higher interest rate to be attractive. So it becomes more expensive for businesses to borrow money for, expanding, buying equipment, even just managing their cash flow.
And those higher costs for businesses,
Yeah.
they don't just absorb them, do they? They tend to filter down.
They have to go somewhere.
Yeah.
And that's where it hits your wallet. It can lead directly to higher interest rates on mortgages.
Making buying a home more expensive.
Definitely. And credit card rates can tick up too. Carrying a balance becomes costlier.
So if mortgage rates go up,
Mhm.
say someone's looking to buy a house right now, what does even a small increase actually mean in practice?
Well, it obviously depends on the loan size, but even say 0.5% increase on a typical mortgage can mean hundreds of dollars extra each month. Over 30 years, that adds up to a lot of money. It really impacts housing affordability.
Hundreds a month.
Okay.
And what about businesses? If their borrowing costs are up, and maybe their import costs are up too because of the tariffs, what do they do?
That's the tough part. The information we have suggests they face some hard choices. Our sources mention they might have to cut back, potentially meaning job cuts to reduce expenses.
Well,
Or the other option is to try and pass those higher costs, both borrowing and tariffs, on to consumers by raising prices for their goods and services.
so either way, it impacts people's financial situation. Like, imagine a local factory using imported parts.
Yeah, perfect example. If those parts suddenly cost way more because of a 104% tariff, the owner has to do something, right? Maybe they can't afford to keep everyone on staff. It's a really difficult position.
But there's another layer to this concern, isn't there? Something potentially bigger. Our source material mentions a point from George Cervelis at Deutsche Bank.
Yes. His point was quite sobering. He raised the possibility that this isn't just about borrowing costs, but maybe about a deeper loss of faith from global investors in U.S. assets generally.
He used the phrase uncharted territory, I think.
He did. And analysts like him don't use phrases like uncharted territory lightly. It suggests something potentially quite serious.
Uncharted territory.
Yeah, it doesn't sound good.
What happens if investors do start losing faith in U.S. assets? What are the knock-on effects?
Well, if global investors get nervous about the U.S. economy or the stability of its debt, they might start pulling their money out, selling U.S. bonds, maybe even U.S. stocks, potentially selling dollars.
And moving that money elsewhere.
Exactly. To markets they see as safer or having better prospects, that would put even more downward pressure on U.S. bond prices, pushing yields even higher, and it could weaken the dollar too.
Is there a precedent for this kind of thing, where market turmoil forces some kind of official response?
There is. Actually, the source material draws a parallel to the UK back in 2022. Remember the market reaction to Liz Truss's budget?
Vaguely, yes, there was a lot of instability.
Right. Investors got really spooked by the government's spending plan, started dumping UK government bonds called gilts. Prices plunged, yield soared, and it got so bad, the Bank of England had to step in with emergency bond buying to stabilize things, prevent a meltdown, essentially.
So the suggestion in our sources is that we could potentially see the U.S. Federal Reserve having to do something similar here. Step in to stop things spiraling.
It's definitely being floated as a possibility. That kind of intervention might become necessary if the sell-off in bonds continues or accelerates. It's a serious scenario to consider.
Okay, so looking ahead then, what are the potential next steps? If the Fed did intervene, what would that look like?
Well, the main tool discussed in the info we have is emergency bond purchases. Essentially, the Fed would start buying U.S. government bonds in the open market.
To push the price up and the yield down.
Exactly, to try and counteract the selling pressure from investors, stabilize prices, and pull those interest rates back down from these highs.
But the sources also seemed a bit cautious about that, didn't they? Like it might not be a permanent solution.
Yes, there's definitely a note of caution. It's described as potentially just a Band-Aid.
A Band-Aid.
Yeah.
Meaning it treats the symptom, the market instability, but not the underlying cause.
Precisely. It wouldn't fix the root problem, which is this escalating trade conflict. That would still be going on in the background.
And speaking of the trade conflict, the fact that China retaliated so strongly with their own tariffs, what does that tell us?
The information suggests it's a clear sign they aren't planning to back down anytime soon. They're digging in. So this trade fight could drag on, continuing to create uncertainty and volatility in the markets. It's a persistent challenge.
Okay, so as we try to make sense of all this moving forward, what are the key things the information we've looked at says we absolutely need to keep an eye on?
Our sources flag a few critical things. First, obviously, future Federal Reserve meetings. Any hints or actions related to bond market intervention will be huge news.
Right. What else?
Second, the real-world impact on prices. Are these tariffs actually showing up as higher prices on store shelves? What's happening with inflation overall? That directly affects household budgets.
Okay, Fed actions, inflation, anything else?
And third, the reaction of the rest of the world. Global markets. Will other big players, say in Europe or Asia, see this as a chance to buy U.S. bonds while prices are lower? Or will they get spooked too and stay away? Their actions could really influence where yields go next.
Those are definitely the big questions. It really hammers home the point, doesn't it? This isn't just some abstract economic debate. This trade war, the bond market reaction,
Yeah.
it's actively reshaping things in ways that could really touch all of our financial lives.
Absolutely. So just to quickly tie the threads together again, we've seen these big tariffs trigger a trade conflict,
Which has led to this unusual instability and sell-off in the U.S. bond market,
causing bond yields and therefore borrowing costs to shoot up.
and raising concerns among analysts about investor confidence in U.S. assets,
Right.
even hinting at potential Fed intervention.
It's all interconnected.
Definitely. So as we wrap up this deep dive, here's maybe one last thing to mull over, something to think about beyond the immediate news cycle. We've talked about market reactions, potential Fed moves, but how might all this trade war, these shifts in the financial markets, how might it affect long-term investment thinking? Could we actually be seeing the start of a shift in the global balance of economic power because of this?
That's a really profound question to leave people with. It's certainly possible these events have implications far beyond just the next few months of market data. It prompts you to think about the bigger picture, doesn't it?
It does.
So as you follow this story, keep those key questions from our sources in mind. Will the Fed step in? Will it work? How high will inflation go? And what will the rest of the world do about U.S. debt? These are the things to watch as this continues to play out.